Hi everyone, thank you for joining us today to hear from Ozan Özkural. We'll get started now, but please do continue to let us know where you're listening from today. So this is the first webinar collaboration between the Cambridge University Technology and Enterprise Club and the Cambridge University Venture Capital and Private Equity Society. I'm Shreya.
And I'm Shelby.
And we're your hosts for this evening. And we're very happy to have Ozan Özkural with us for this event. So the format of this is going to be the first 20 minutes or so. Ozan will be giving us a presentation, and during this time, please do post questions in the chat. And Shelby and I will be asking some of your questions to Ozan in the final 40 minutes or so of the webinar. So keep those questions rolling in. And before we start, we wanted to very quickly mention the groups that are involved in making this event happen for you. So first of all, we've got Q Talks by Q Tech, which is a leading how-to podcast series for tech founders and aspiring innovators. We've had some incredible guests so far, including founders, investors, and experts. And this webinar is our first live event as part of Q Talks. So if you're feeling bored like me during quarantine, or looking for new content, then please do check out the podcast at the link that's on the screen, or you can scan the QR code, and I'll put the QR code up at the end as well.
The other society initiating this event is the Venture Capital and Private Equity Society at Cambridge University. We're a society which is passionate about educating students about the fascinating world of investing in private companies. This year, we were very pleased to launch a volunteer program called Due Diligence Projects, where we use our discipline-relevant expertise to diligence early-stage companies for Cambridge-based VCs and accelerators. In addition, we frequently host Octopus Ventures and Tanto Capital Partners for speaker events at Judge Business School. Please feel free to follow us on Facebook to learn how to get involved, and that's at CUVCPE. And now to introducing Ozan, the guy that we're all here for. Ozan is the longest standing friend and lecturer of the Venture Capital and Private Equity Society, and a man that hardly needs an introduction. He's the co-founder and managing partner of Tanto Capital Partners, a private credit fund and a boutique advisory firm since 2015. Ozan started his career 18 years ago as a management trainee at Unilever, where he rose to become a business group finance manager and also qualified as a chartered management accountant. He then trained at Merrill Lynch in 2005 as an investment banker, focusing on structured financing, distressed debt trading, and principal investments. Ozan subsequently rose through the ranks and later on ran part of the emerging markets and origination team. Throughout his time at Merrill Lynch, Ozan originated and managed transactions totaling close to $50 billion US. Subsequently, leaving the firm in 2012 to set up and run the Turkish and part of the emerging markets business of Russia's second largest bank, VTB Capital, before co-founding Tanto Capital Partners. Ozan has been appointed to the Foreign Policy Leadership Council of the Brookings Institution, a Washington, D.C.-based think tank, in 2017, and is a regular participant at the Davos World Economic Forum, the annual World Bank, IMF, and the UN General Assembly meetings. He is a regular contributor to Bloomberg, CNBC Squawk Box, and frequently pins op-eds for the Business Week magazine. Over the past few years, Ozan has been interviewed by the likes of broadcasting legend Larry King, as well as by the Pulitzer Prize-winning journalist Eric Lipton from the New York Times. We're looking forward to hearing what Ozan has to think about COVID-19 and the economy. Thank you for joining us, Ozan.
Well, Shelby, thank you. And I must say, you can always introduce me anywhere else from now on. That was fantastic, really. But thank you so much. And thank you, everyone. It's wonderful to be a part of this yet again. And this time reaching over to 500 people around the globe. Some I know and some that I don't know. But nonetheless, I think it's fair to say that we live in momentous times, and now more than ever, it's very important to communicate, to connect, and to try to make some sense of what is going on in the markets. And that's what I shall aim to do in the first 20 minutes of the presentation. And as it always used to be the case in the physical lectures, the more interaction we have later down the line, the better it is. So I will aim to keep it as succinct and as short as possible. But before we start, I think it's fair to just underline that every crisis has a human element. And we always try to work around and circumnavigate the eternal dance between fear and greed that has always happened since the beginning of time. And today is not any different. This time, different to other crises that I certainly have been through, which 2008 was the main one, this is one that affects a much wider audience all around the world. It is not just a financial crisis. It is not just a corporate crisis, but it is something that impacts every one of us, our families, our well-being, and our livelihoods. So I just wanted to highlight that and the importance of this before diving into more technical, economic, and geopolitical elements of this, because it is easy whilst analyzing numbers to forget the human impact, and I think we should never forget the human impact. We are right now collectively in an anxious state, facing the pandemic. However, as someone that has been in the eye of the storm in 2008 global financial crisis, when we all thought that the world was coming to an end, I can assure you the world is not coming to an end, and I remain optimistic about the resolve of the human spirit in the long run and the fact that we shall prevail. Now, having said that, I'm an investor, and the questions that I've been getting over the past 6-7 weeks, both as Tanto Capital Partners and as myself, has focused around, obviously, how to invest and how to analyze risk in the chaos that we live in. But before we get there, let's just start with an admission that I think is fair to make. No one in the world right now knows exactly what is going to transpire over the next weeks, months, or years. I think it's important to acknowledge that fact when trying to opine on how to circumnavigate the challenges that lies ahead as an investor. Now, let's also take a quick look at a pre-COVID-19 modus operandi and where we were as a world just over 2.5 months ago. From a social and economic backdrop perspective, the banking sector was in a much better shape than it was 12 years ago when the global financial crisis had transpired. Although there were increasing concerns around the amount of leverage that we were once again seeing, and not just this time in terms of bank balance sheets, but in balance sheets of households and corporates. Perhaps what's more interesting is the social and the geopolitical background that we were in before COVID-19. Look, given the dominance of social media and the incredible asset price bubble that followed through the 2008 crisis, where the distribution of capital was not done fairly, the asset price bubble basically meant that people that had assets became richer and people that did not have assets remained where they are. So, there was a gap between the rich getting richer and the less rich staying put as they were. Combined with the fact that we all now live in an interconnected society where everyone knows what everybody else is doing, we were already facing the rise in populism, driven by the fact that people were just fed up of seeing how the other half lived. That meant that we were already focusing and kind of getting more towards a less globalized world, with the rise of nationalism becoming prevalent in many different countries. And we'll understand why that's relevant when we go down to kind of following through what this means for the investment cycle. Also, we were already in the middle of a growing US-China trade war. Arguably, the only geopolitical battle that really matters from a strategic perspective in the long run is the battle between US and I would say US plus the liberal Western world, for lack of a better word, versus China. Also, there were a number of increasing proxy wars around the region. We heard little, but nonetheless, lives were being lost. And there I look at more the Middle East, in Yemen, in Lebanon, in Iraq, Syria, the human cost was already increasing. And finally, if you take a look at closer to home and we look at the European Union, we already had Brexit. That was something that was quite contagious for people that live in the UK and live outside. And European Union, as my dear friend Marco Carnelos, who's a prominent diplomat, had told me the other day, was already facing the movement towards a two-speed Europe, a Europe that will and most likely will become more fragmented. So the backdrop wasn't exactly benign before the whole COVID-19 debacle started. So before we move on to the questions that I get asked around investments, 2 points to raise. Number one, oil prices. I'm sure all of you are aware that we slipped into what we call negative oil price territory just last Monday. And obviously the question is, well, how could you have negative oil prices? What does that mean? It is a notion that we refer to as contango or forwardation, which effectively means that the future price of a commodity is higher than what it is right now, which means also that investors are expecting an upward sloping kind of forward curve, if you will, or pricing that in at the moment. Now, the petroleum industry is fundamentally very important, obviously financially, but also geopolitically. So the question is, how did we come here? Now, it's also fair to underline that in 2019, roughly 40% of the rise in demand on oil came from China. That's a significant portion of your rise in demand coming from a single country. So clearly, after COVID-19, that demand fell away. What then happened, of course, is that the governance and the governing bodies around supply, which is predominantly what we call OPEC plus, which is OPEC plus Russia, plus US and Norway, decided to move. However, they did not move fast enough to create a bottom for the supply. And therefore, we found ourselves in a situation where just last Monday, traders realized that actually, despite of all the oil cuts that people have agreed to instigate, the world faces a significant oversupply of oil that is likely to remain as is going forward throughout the year. Just to give you some numbers, before the COVID-19, the world was consuming roughly around 100 million barrels of oil a day. Demand is now somewhere between 65 to 70 million barrels a day. So in the worst case scenario, about a third of the global output of oil needs to be shut. That's an important factor to keep in mind. And one final point about the geopolitical challenges. Let's not forget that we are in a US election cycle this year, which obviously drives a lot of the US policy making vis-a-vis both foreign policy, but also what this means in terms of the presence of US leadership in a global crisis, where arguably the world more than ever needs larger, wealthier countries to act in a coordinated fashion and work together to help us see through this crisis. And right now, unfortunately, in the US, we can safely say, and this is not taking any sides, whether you're a Trump supporter or not Trump supporter, it is fair to say that local election dynamics will be a priority, which will determine how the US potentially reacts into or towards a global concern around COVID-19. Now that that's out of the way, moving on to the economic part of the equation. So there are 4 questions that I got asked that I can actually kind of solidly remember over the course of the past 6-7 weeks. Question number 1 is, how will growth be impacted as a result of COVID-19? I think it's fair to say that the growth overall around the world will decline. But what is important is, and what a lot of investors don't necessarily acknowledge right now, is that we are also going to be doing this whilst going through a massive deleveraging cycle, which is unlike the downturn in 2008, will actually make this much more of a corporate crisis rather than just a financial crisis. So the road ahead will most certainly be a bumpy one. China's strategy of containment of the COVID-19 was quite unique, to say the least. So no other country has really been able to replicate the same speed and, I guess, strength of containment in the developed world, which also means that the growth contraction will mostly come through the services economy, including travel, leisure, which obviously affects US and Europe significantly more than it does Asia. COVID-19 is an unprecedented shock to the system that could result in significantly negative GDP quarters. I think roughly most investors are pricing a GDP decline of 12 to 15% in the US alone, which, considering the size of the US economy, is just beyond anything that we have seen so far. Just to give you an idea, in the global financial crisis in 2018, the GDP contraction was only 4%. So this is more than 3 times the amount of GDP contraction that we are pricing in for the US alone in this crisis. So it gives you an idea of how significant and massive the challenges will be. Interestingly, large emerging markets like China and India are going to continue rather, having positive GDP growth, albeit at a much lower levels than we thought before. So you can see how the world is kind of being divided also in terms of which countries will grow and which countries will not. Now, one important factor in this crisis is requiring all governments around the world to step up and to get involved like never before. But unlike the previous crisis, this will not be a situation where governments just can flood the world with money, which they will. But in this case, the money has to go directly to recapitalize the household balance sheets and not just the bank balance sheets. Because frankly, we just don't know how long this will last. And we all need money to survive, to spend, and therefore to keep some sense of normality of the capitalist system that we have all been living under for the past 75, close to 80 years. So the deleveraging that we're going to go through will take years, not months. So therefore, question number 1 answered, how will this impact growth? Unfortunately, very negatively in the Western world, and actually just negatively in general around the world. So question number 2, as an investor, can you price the risk that we are facing right now? And the answer is not perfectly. I mean, at any given moment, even in the best case scenario, it is difficult to price risk unless you can understand the risk that you're facing. And right now, even in the high yield markets in the US, implied default ratings are somewhere around 12 to 15%, which is significantly higher than the historical average of 6%, which means that, you know, we are now approaching levels that are close to the global financial crisis level in 2008. You know, the question is, if you can price it, will you buy it? We are focusing much more on the importance of being able to go long credit. Credit is something that you can price easier than equity in a market like this, because frankly, right now, even though we witnessed a significant rally in the stock market, I don't buy that too much, because it is very difficult to understand the real impact of what we are going through until we see corporate earnings around the world that are going to be coming out over the course of this week and next week. So until that, it is very difficult to kind of price that risk. And it's something worthwhile remembering is that in terms of our leverage, our borrowing, the world debt loads are roughly around 242% of GDP right now, versus their previous peak of 210% in 2007. So it just gives you an idea as to how levered the entire world is, which makes it very difficult to price equity right now, but easier, relatively easier to price credit for the time being. So question number 3, can we apply some of the lessons that we have learned from the past crisis onto this crisis right now? And if so, what are those lessons? I would say number 1, economic growth is likely to get worse in the near term. So S&P 500 peak to trough fell roughly about 34% in the COVID-19 crisis so far. That decline sounds a lot. That decline sounds significantly material, and it is, but compared to the previous crisis, we are not close to where the bottom could be. In 2000-2001 crisis, the dot-com bubble burst, the decline was 51%. In 1929, the Great Depression, the decline was 86%. This is a once-in-a-century pandemic, so it is entirely plausible that what we are witnessing right now is a bear market rally, and the future declines will be there. However, I don't think, and we don't think, the decline will be any more than historical averages. It's just that we are saying that there is still some way to go until we achieve those historical average levels yet. So within private equity, what does that mean? We forecast a significant amount of divestment activity, rescue financings, liquidity bridges, restructurings, and industry roll-ups coming our way. So if one is capitalized well enough, and that is going to be the trick here, opportunities will present themselves. However, I think it's fair to say that we have to be patient and plugged into the deleveraging cycle to be able to make meaningful investments, and that time is not yet upon us exactly. So question number 4, and then we'll take questions from the audience. What does this all mean for key investment themes, right? So, how do you allocate? Where do you invest? One thing I would say is keeping cash has never been this important. Now, normally as an investor, you do not want to keep so much cash because it gives you what we call a negative yield, negative carry rather. But in this case, given that the significant returns are going to be made by buying assets when the asset price collapse takes place, keeping cash is not just a prudent metric to be able to protect yourself against bankruptcy, because the reality is a lot of your competition will go bankrupt. A lot of companies across a lot of sectors that are thinly capitalized will not survive this crisis. So if you are cashed up, if you can survive, by doing just that, you are going to capture market share. Plus, you will be able to buy assets in the cheap when they come to the market. That's number 1. So keep as much cash as plausible. And of course, you have to have some yield enhancement. And there, I think the idea is to be able to focus on credit, developed market credit, as well as an element, albeit selectively, going into some emerging market countries, not all, but those, such as I would say probably Mexico, Brazil, and potentially Turkey, where the manufacturing sectors of these countries will benefit from the fallout from the world's relationship with Chinese producers. The world is going to be looking to diversify its production, its supply chain, away from being dependent solely on China. And there are only a handful of countries in emerging markets, such as Turkey, Mexico, and Brazil, that could handle the manufacturing demand that will come our way. So with that, I will just end my analysis and take questions. Shall we?
Hi, Ozan. Really, thank you so much for that. We have a question from Sheelin Chin about how long will it take for global demand to recover, both for oil and for other things like commercial goods?
Okay, so I think it depends on what we mean by recover. You know, look, even pre-COVID-19, the oil demand had passed its peak. We are going through a paradigm shift of how we consume, how we travel, and that already was putting pressure on the oil prices. So if the question is, will oil recover to prices of $70, $80, $90, I think it's highly unlikely. But in terms of recovering back into some sort of a normality, which let's just say is around the $40 range, I really think that it is going to take place over the course of next 12 to 18 months. Although I do want to put a caveat there saying this is a part of this crisis that makes it very difficult to price any strategy, because we just don't know when we are going to be able to travel again. You know, if the countries right now suddenly say, guys, okay, this was just a quick crisis, okay, it's all over now, but we haven't yet found a cure or a vaccine for COVID-19, will people be kind of motivated to travel? Do they want to really get onto those cramped plane seats and then travel somewhere else? And two, will they have the money to travel? So I think this will take a significant amount of time to recover. Now, a part of that answer to that question is demand related. From a price perspective, the world oil infrastructure is not something you can just shut off or cut quickly. It works on more of a dimmer switch rather than a light switch. So kind of being conscious of that, I would probably conservatively say that we are in this range of oil prices for the foreseeable future, which is, I would say, probably the next 12 months.
Okay, we have another question from Judy Zhu. Do you reckon developed and developing countries will spend more or less on infrastructure after the COVID crisis?
Yes, absolutely. Especially the healthcare infrastructure is going to be obviously quite an important one. Traditionally, independent of the COVID-19 crisis, if one takes a look at the ultra micro demographics of the fact that the world population is growing, you will always need energy infrastructure, communication infrastructure, agricultural, food supply infrastructure, and now obviously an enhanced focus on healthcare infrastructure, which, by the way, is going to be another way where governments can look to create jobs that this crisis will otherwise shed as a result of that. So definitely they will.
Okay, another question from Kareem Merchant. Will quantitative easing have the desired results in freeing up liquidity to buffer Western economies?
It depends on which Western economies we're talking about. And here we face an interesting scenario where not all countries are the same. Not all countries are as powerful or as wealthy as the others. So to the extent of will countries, by the way, Western countries or otherwise, will countries kind of print money? Yes. Monetary policy in the Western world, there's nothing much left to speak of because rates are at historical lows. But fiscal policy will be key. QE will continue. Countries will flood the market with as much liquidity as it takes because they have to. Because don't forget, this is not a crisis that is limited to a bunch of bankers or people in the financial services sector. This impacts everyone. They have to print money and they have to use banks as SPVs, if you will, to recapitalize the entire household balance sheets. So to that end, they will print money. Will it work? Well, it really very much depends on how quickly we can get back on our feet and head towards some sense of normalization. And we will all see that. There is no clear answer to that question, unfortunately, more than that.
Mm. And on that note, the UK government, as you know, is £2 trillion in debt. The US government is $27 trillion in debt. How can governments bail out society? And if COVID lasts a year, are we able to infinitely borrow to avoid an economic depression?
Well, the short answer is we will have to. And to the extent, look, again, here, for example, the US government is in a much more stronger position than any other government, because frankly, US dollar, as we've been saying in all of our previous lectures, US dollar is the only reserve currency in the world, which means that theoretically, US can print dollars and spend anywhere else in the world. So that's what will happen. And yes, the borrowing levels and debt levels will increase, but that's only because it has to. Now, to kind of answer that question from a different dimension, I think this will bring about a paradigm shift in how we govern, how we live, how we work. And so the from that perspective, COVID-19 has been a catalyst to magnifying the existing winds of change that we were all facing as a society. Perhaps the way that governments will work will change, because actually, in effect, even though they're not calling it this, what is happening is that certain strategic companies in certain strategic sectors are being nationalized and will end up being nationalized. Now, we will not call it that because that's a bad word to use, but in effect, that is what's going to happen. So to that end, yeah, we will have to print money and save everyone, unfortunately. Or fortunately in this case.
Yeah, absolutely. We have a question from Jack Spencer from Exergy Capital. He's wondering if you might be able to shed some light on your thoughts with regards to private market fundraising and the wider LP landscape within EMEA in this current crisis in half to 2020.
Look, that's a very good question, and it's a space that we operate under. And by the way, we are going through similar processes and trying to raise capital from different LPs to be able to benefit from the asset price contraction that will come about. It is not easy, and this is where the disconnect is, because right now the developed markets, so the more liquid or more risk-free markets, have gone through significant dislocation. So a lot of the LPs and a lot of the funds have basically been looking at, look, how can we benefit and how can we make money from the asset classes and the sectors that are less risky than the emerging markets. So unfortunately, this means two things. Yes, LPs will come back to look at allocating capital to emerging markets because it is a significant asset class space that you just cannot not allocate capital to. But timing of it is not going to be immediately right now. It is going to be an iterative process. And by the way, it will be much more selective than it was before. So, focusing on distress, focusing on anything that is asset-backed, anything that can create cash flows that, has some collateral behind it. Anything that is in countries that, again, will partially benefit from the fallout between the West and China in terms of supply chain. And number two, there will be repricing, and that is what you're seeing right now in the market. So, if you're an LP and, right now in this current market, you are making 18, 20% in the US, you're going to ask for 30, 35, 40% in developed markets, emerging markets. Have the asset prices come down that much in emerging markets? Not yet. So I foresee the asset price contraction becoming significantly more pronounced in emerging markets. And to answer his question, the challenge right now for funds like ourselves is to be able to convince LPs to fund right now and then to wait. But it is very tough, very tough.
And in the same vein, Nathan Howell was asking about the appetite of ESG-based investment in public and private markets and how this will be affected by COVID-19, and also how you plan on adjusting your own investment strategy after the crisis.
Yes, very good question. ESG investing has never been so relevant, and I think its relevance will continue to increase, and smart fund managers will look to tap into being able to allocate ESG capital. And by the way, also, it's important to differentiate here between ESG and impact investing. Most people tend to kind of confuse that. ESG is something that a lot of funds and a lot of institutions have paid lip service to. It is kind of easy money, cheap money, but not necessarily free money. Whereas impact investment is also going to pick up significantly. And to those funds that can meaningfully structure on the ground operations in countries that do need ESG financing and impact investment financing, provided that they can use a method we call blended financing, will do well out of it. But absolutely, money going towards ESG will continue to rise.
We have a question from Iona Harrison. What impact will COVID-19 have on inequality in comparison to previous shocks in the 20th century? For example, World Wars I and II.
I mean, it's difficult for me to compare, realistically how inequality was impacted in World War I and II, but unfortunately, we do face a reality that, look, this crisis, or the healthcare part of this crisis, does not discriminate poor versus rich, ethnicity, sexuality, religion, background, does not differentiate. However, as with all crises, people that have come into this and found themselves in a cash-rich position will be much better off than those people that are poorer that need the cash. So from that perspective, yes, like in any crisis, the inequalities in the world, unfortunately, will most likely magnify.
Amy Still is asking about what the new world order will look like. Will there be a change in supply chains? Will there be more or less consumerism? How will our consumer habits be affected by AI and tech?
Look, I mean, again, pre-COVID-19, that question is valid, very valid, even pre-COVID-19. I mean, AI, machine learning, especially blockchain, in time will come and change the way we live, we spend, we work, we interact. And what COVID-19, I think, will do in this case, again, will be a catalyst to push humankind into being digitalized, for lack of a better word. Now, that is quite a contagious topic. If one were to come and say, guys, you know what, let's all just put chips in you, and then let's all kind of be a part of the Internet of Things and Internet of Everything, there will be significant pushback in saying, I don't want to have a chip in my body. One can never know. Maybe this will be the push that through the healthcare dimension of digitalization will actually significantly change the way we are a part of the system. Now, how does that impact spending habits, consumer behavior? I think throughout this crisis, one paradigm shift that we have all had, for example, is that, we don't necessarily need to spend as much money on corporate travel as we thought that we needed to do before. Now, we will spend some money, but not as much money. We don't need to spend as much money in traveling from home to work, because guess what? I think going forward, people's approach towards working from home will change and has changed already fundamentally. So what does that mean? Obviously, the consumer spending habits will change in line with the new way that we are going to work and commute. And I think those two things are here to stay.
We have a question from Rocco de Amaro. Are the Euro bonds, so-called Corona bonds, going to help finance actions needed to support economic activities?
The short answer is yes, they will. Again, those Corona bonds, which are kind of similar to, I guess, war bonds, are going to be a primary mechanism through which governments and sovereigns will borrow in the market. You see, in this crisis, and especially for those countries that are less well off and are in the emerging markets realm, it is the government's job to be able to borrow and then to recapitalize their respective industries. Corporate borrowers will find it very difficult unless they are top tier corporate borrowers, which I'm talking about US and European kind of blue chip names, will find it very difficult to borrow in the capital markets. And if they do, the pricing is going to be punitive. So I think governments will do the borrowing for most corporate sectors, and therefore, the COVID bonds, Corona bonds, will be a mechanism.
Helen Poon is asking, how will the deleveraging affect returns that PE firms can generate?
It's a good question, because traditionally a lot of the returns were magnified by being able to tap the leverage market. Look, PE firms again will have to focus not on leverage anymore, but being able to work on divestments, restructuring balance sheets, and therefore looking at going into those firms where if the fundamental going concern of that business will not have been affected post COVID-19, and that is a big if, by the way. So side note, a lot of the firms and a lot of the companies right now are and should get together with their board of directors and have a hard, long look as to whether their current business models will be feasible for the new normal. Having said that, even if they are relevant, a lot of them that are going to have financial funding difficulties, but where their underlying business model is a healthy one, will be available for acquisition. And therefore, that will drive the price of those firms down. And that's where private equity firms can really continue creating value.
Max Antcliffe has a question. You mentioned that investment opportunities will start to present themselves at some point. Are there any particular sectors you think this will be true for? And when do you see this playing out?
Look, the van is a difficult one, but suffice it to say that I think the opportunities for those investors that can have access will be through their connectivity with the banks, because a lot of the fire sale, if you will take place through the bank's balance sheets. The timing, one cannot really know so well. It depends on jurisdiction, depends on the sector, depends on on the country. In terms of what sectors will benefit. Now, I would kind of separate that into one, distressed, and the other, technology. Clearly, it's logical to say that communication tech, healthcare, biotechnology, agri-tech, those things are going to be growing, and therefore there will be positive differentiation in terms of those asset classes. When it comes to distressed, I think real estate will suffer. Commercial real estate will most certainly suffer. Aviation, tourism. However, aviation and tourism will come back. Aviation is a bit more difficult to price because aviation firms have huge fixed costs that they cannot really get out of. Therefore, in this crisis, what we will see in the aviation sector is that a lot of the national carriers will be saved, and they will actually become nationalized, for lack of a better word. Budget airlines will go out of business. It's very dangerous to pick one up unless you know exactly when the market will open, but there may be opportunities there. When it comes to tourism assets, I think that may end up being quite attractive, because I refuse to believe that we are going to stop traveling and stop going on holidays once this crisis has passed. So therefore, it may be a good time to look at picking up some assets from that sector. But timing is very difficult to forecast.
We've got a question from Sihaim Bentaleb, sorry if I said your name wrong, that some experts state that we will be witnessing a world less globalized after this pandemic. Do you agree with this? And what do you think the consequences will be on globalization?
Look, I mean, I agree. By that, what I mean is that we're going to be living in or shifting towards what we call a multipolar world, where the global footprint includes more distinct regional connectivity than it did before. And that is natural. That's a natural consequence of what is going on here. Now, we are all now interconnected. There is no escape from the macro trend towards increased globalization going forward. But in the short term, power bases will change. Interdependence on any production, for example, on any one country will no longer be a good thing. It is entirely plausible that countries will rebrand certain sectors strategically important, and therefore increase protectionist behavior around those sectors. So yes, we are moving towards a multipolar world. And what that means is that we are going to be living in a less certain world for a time being.
Just to add on to that personal question that I have, do you think that by more people working from home and being able to have such international conversations, such as we're having, but also professionally, that might have an impact on globalization and the business that is being done?
So I couldn't catch the last part, Shelby.
So do you think that more people being able to have international conversations by remote working is going to have an impact on globalization as well?
From that perspective alone, I don't think so, because don't forget that we already had possessed the global communication infrastructure that we had. So it wasn't the case that we could not communicate or connect with someone that was around the other part of the world. It's just that we were held back by either cultural biases, work practices, and just general tendency to resist significant change in terms of changing anything major. So, will it make us more globalized? I don't think so, because we were already globalized when it counted. Because you were already doing trade around the world. But will it make it, I would say, more effective and cheaper to run businesses that are globalized? I think that that will happen.
Great, thanks. Amy Still has asked, do you think that companies will have much less money and less power compared to the current government, so there will be less lobbying from capitalists and more governmental control?
There will never be less lobbying from the capitalists, quote unquote, because we, by the way, all are part of a capitalist system. Governments remain governments, business people remain business people, and don't forget, as human beings, we are all, both blessed and plagued with having very short-term memories. So whatever we think is going to be the new norm forever and ever is never going to be the case. Okay, we will forget, and we will revert back to the eternal dance between fear and greed. Right now, we are full-on fear mode. Once that fear alleviates over the course of the next couple of years, believe me, we are going to slowly but surely get into the greed mode again. So I don't think the fundamental way of doing business will change, although in the short term, yes, governments will have to take a much larger role because they are paying for it.
Iona Harrison has asked, will COVID-19 catalyze the retreat of the US as a global superpower?
That's a good question. Judging by the way that the US is reacting right now, I would say yes. But this was true even before COVID-19. And I want to be careful in saying this because US state is different than a US politician specifically, although all of our actions have consequences. And COVID-19 has made very, plainly aware of the fragilities of certain nations versus others, the capacity to deal with the human cost and the financial cost, and the propensity of those nations to offer a helping hand to those traditional allies that were a part of the traditional liberal world order. So I think to that end, US has suffered a loss to her soft power. But that was the case in any case before COVID-19 throughout the past 3 years. If you follow the foreign policy apparatus and the approach to what has been transpiring around the world vis-a-vis different international agreements that US had brokered previously, whether it's the JCPOA, which is the Joint Comprehensive Plan of Action, aka the Iran deal, whether it's the TPP, the Trans-Pacific Partnership, aka the China deal, US versus China deal, US has withdrawn, I guess, to an extent from the global stage. And it's only natural that somebody else will most likely try to take her place.
Izzy Taylor has asked, could this crisis be a turning point to decrease the gap between the rich and the poor, both within and between countries?
You know what? If we were all intent on doing so, it would be a perfect opportunity to do so. Just because, this has leveled everyone and every sector and everything. I would love to believe that that would be the case. However, my sense tells me otherwise, because even pre-COVID-19, the world had the resources to be able to make it a better place, a more fair place. It is ridiculous and frankly criminal to have a system whereby we have simultaneous obesity and hunger. How does one explain that? Not because of lack of resources, it's because of lack of political capital and the willingness to do so. So I would love to believe that, although I unfortunately think that will not be the case.
So in 2008, Ray Dalio's famous Pure Alpha Fund grew 9%. And since the beginning of this year, that fund has fallen 20%. How do you think COVID-19 has altered the established hegemony in the hedge fund asset management space? And will the big players be the same after the crisis?
It's too soon to say. It's way too soon to say. Because I think one thing is for clear, that in any crisis, active managers do better than passive managers. Because look, it's easy to make money when everything is going up. It's only through real volatility and shock where more informed, better positioned investors kind of present themselves. I think it's fair to say in that case that it is better to go for quality on the way down, and then slowly by surely building up more higher yielding and structured products on the way up. But short answer to your question is, it's way too early to call that.
Sally Sai is asking, will the pandemic be used by governments to infringe human rights, limit freedoms of individuals, and monitor citizens more going forwards?
Well, the short answer to that question is, or with the question, depends on which government you're talking about. I think to a certain extent, certain governments in the world have already started doing that. Is it conceivable that certain nations and certain governments will capitalize on this to create a more controlling ecosystem? Absolutely, I think it is. Do I think that is going to be the norm around the world? I don't think so. I don't think it's in anyone's interest to really have that feeling of over control. Although, again, going back to my earlier comments, I do believe that this is going to be a catalyst for all of us to move towards the digitalization of human beings. Now, that's not a governmental thing. It is just a fact of life. Will some governments capitalize on this? I think so.
Thanks. Felicia Zhu has asked, what are you doing to change the structure of your portfolio investments in light of the upcoming recession and in response to COVID-19?
Well, again, look, we are a private credit / distressed fund, and we have a significant advisory business in tandem to that. So from my perspective, provided that we can plug ourselves into a captive pool of LPs, and the structure is debatable, whether it will be in a fund structure or maybe perhaps a multi-family office structure that runs alongside our existing structure. But we are going to be looking to benefit from being able to pick up certain assets when the price becomes right. And therefore, the most important thing there again is to be able to find the right investors and right LPs, because it is going to take patience and discipline. On the other hand, we have an investment on a biotech space in the US. That investment is doing quite well, and I think that space will pick up. So I think we are relatively well hedged, although we could use, as most funds can, more liquidity.
We have a question from Baron Ball. How should startups raise capital under these conditions? What would you suggest to the entrepreneurs in this regard?
I would suggest for them to brace for impact, because the competition for capital is going to become fierce. And I think I would like to think that a good idea will always sell, but I would take the only suggestion that I can give, and again, this is a tough one because if nothing else, we do live in an extremely dynamic world. I would suggest for those entrepreneurs to really take a hard look as to whether the idea that they had pre-COVID-19 still adds value, still is relevant, and does it solve a problem? And if the answer to that question is yes, it does, then I think venture capital funding will still exist. It's just that right now people are panicking. So therefore, the priority may not necessarily be as much venture capital funding as it was prior to COVID-19.
Quite a few people have been asking about real estate. So I was wondering if you could talk about what do you think will happen to commercial real estate and how will it be influenced by COVID-19?
I think commercial real estate is the one area where we can make a reasonably solid guess in terms of the prospects. And that is not looking very good. Look, one of our partners that also is an advisor to a major UK energy company, roughly about a month ago, when we were still able to kind of meet, had a meeting and said, look, you know what, it was a trading floor with 400 people, but only 12 people were there, but yet they were still making money. Now, does this mean that we are not going to need offices? No, it does not mean that. But does this mean that we are going to need as large an office for a firm? Absolutely not. This crisis was a litmus test for the global IT communications infrastructure, which now we know is capable in handling working from home. Also, this has allowed us to go again through this paradigm shift of, can we work from home? Is it nice to work from home? So I think we are going to see a significant shift in terms of companies, maybe at the outset incentivizing their employees to stay and work from home. Those people that are senior business leaders, that are front office people that need to still cultivate relationships with one another, yes, they will always need an office space. But will the middle office, back office, infrastructure, IT teams need one? I don't think so. So therefore, I think we are in a significant and persistent decline in terms of commercial real estate space. That also presents opportunities alongside with it. If you're in a city like London, where there is an acute shortage of residential housing stock, one can imagine that there will be projects around converting commercial real estate into residential at some stage.
Great. So I know it's coming up to time, but we've had quite a few more questions. So if we're okay,
sure, go ahead. Yes, that's fine.
Great. So a lot of people want me to ask Bill's question. So Bill Taylor has asked, do you think that the UK's decision to leave the EU puts it in a weaker or stronger, position to tackle the economic challenges that lie ahead? Would Brexit make it any easier for the UK to implement the required monetary measures?
Sorry, ladies, give me a second because I need to, charge my AirPods.
Yeah, no problem.
I can't hear so well. Let me see if this works. Shelby, can you say that again?
So Bill Taylor has asked, do you think that the UK's decision to leave the EU puts it in a weaker or stronger position to tackle the economic challenges that lie ahead? Would Brexit make it any easier for the UK to implement the required monetary measures?
Look, that's a that's a good question, and that's very topical, and it will what I say may be divisive. And I'm not debating the merit of Brexit or not merit of Brexit in this case, but look, the challenge is that UK executing Brexit would have given UK the power to be able to deregulate, to lower taxes for corporates, and therefore play on the importance of London in particular as a hub for the financial services sector, plus for technology innovation in different parts of the UK. Now, with COVID-19, what will become very difficult is for the government, and like other governments in the world, not to tax and increase taxes as a result. The money that we are getting right now is not free money. Someone will have to pay for that. And therefore, all governments will look at increasing taxes in one way, shape, or another, which in the case of the UK and Brexit will cause a problem. Simultaneously, I think we have all witnessed that the European Union in its current format does not necessarily function well. And I think there, Europe is going to find herself in a position where, certain countries like Italy or Spain or Greece may decide to reevaluate how they want to be a part of the European Union. That doesn't mean that the EU will break up, even though Brexit has provided a very, I guess, useful, if you will, a precedent to do that divorce. But maybe EU will change. And I forecast, and I would think, if I were a betting man, I would say that a lot of the kind of non-Western European countries will look at coming out of the common currency. It is very difficult for the European Central Bank to apply the right policies that is right for a country like Germany and France, and at the same time, a country like Greece and Portugal. So a long answer to your question is both an opportunity and a huge challenge, but we will all see what happens. But I think people are, the dividing lines between different factions within the EU will become much more evident as a result.
Okay, a question from Jack Spencer regarding ONG. How do you foresee the market for non-E&P infrastructure moving forward? Will private equity continue to pick up pipelines and terminals, or have the less than spectacular returns shifted focus?
Look, I mean, that's a very technical and sector-specific question. What we can say about LNG, and I'm not an expert in LNG, by the way, so upfront kind of caveat on that, is that LNG will be required much more than obviously oil. Gas is, I mean, I think the future of LNG is quite bright. The fact that we're all home, we are now spending much more time using computers, much more, spending more electricity, is a natural winning, landscape for LNG and natural gas, whereas not so much for oil, although they are kind of interlinked in a certain mechanism. Sorry, not quite that, oil and gas, not LNG. So was the question about oil and gas or LNG?
Oil and gas, I think.
Well, I mean, look, oil and gas, we are in a terminal decline just because the consumer element had changed anyway, right? I mean, we are all looking at driving electric cars in the future. Looking at more environmentally friendly sources of energy. So we already had passed peak demand, I think, in terms of consumption. So given COVID-19 and the significant drop in demand and the subsequent follow-up through supply cuts that will most certainly come through from OPEC plus countries, I don't think there is going to be much need to invest in oil and gas, or rather oil infrastructure. Because the fact of the matter is, right now, we are having issues with storage, let alone investing in the infrastructure to up supply. So I think oil and commodity-based countries, I would probably carve out LNG out of there, are in for a long decline in terms of their revenues. And when it comes to countries that depend on a commodity economy to balance their budgets. And I'm looking at more GCC here, and there is a differentiation between GCC. I know we have Saudi friends on the call. I don't know if there are any Qataris or other GCC nationals here, but for example, given the fact that Saudi Arabia is a young, large country that has a chronic unemployment issue, the cost of the social contract in Saudi Arabia is significantly higher than, for example, say that of Oman or Qatar. So therefore, how do you pay for that? So I think the monies that may have gone towards oil infrastructure in those countries may be well diverted into diversifying away from oil.
Perfect. And I think as the final question in the interest of time, Rocco Damaro has asked, we live in uncertain times where fear and anger tend to take over. Bank loans are not the right solution for all businesses facing distress with COVID-19. Approving a small number of businesses so far is a failure by the banking sector to act in the national interest. Does it seem to you that we're facing a 2008 scenario again? We bailed them out back then. Is it not their turn to do their part now?
Look, I absolutely agree that the banks are not doing anywhere close to enough right now. And I get angry, and I'm an ex-banker, and I'm part of the capitalist financing, sector, right? What the banks are right now making the mistake of thinking that it is up to them to disperse money to household balance sheets and small business balance sheets. It is not. This is a scenario where, again, we have to, and governments have to, recapitalize small business balance sheets, household balance sheets, and they're going to be paying for it. Banks are a conduit and the most effective conduit to do so. So I think there is a lag between what the governments want to do, and again, it is different in different countries. Certain countries are much better at that than other countries, right? But to answer this question, yes, it is time, but this time it's not the bank's money, it's the government's money. Number two, is it going to be a 2008 kind of scenario? No, it cannot be. Because what happened in 2008 again is that the money that came really enriched the rich. This time, the money that gets dispersed will have to go in a much more equal, even footing, having the caveat there to say that it is going to be a toss-up between speed and accuracy. And I think most governments will take speed over accuracy. So will some benefits or some businesses or some wealthy people benefit from the cash that comes down from the government? Yes. But that's because we just don't have the time to be able to make this a fine-tuned exercise in terms of who deserves it. We need speed, we need that money now, and we need banks to play ball.
Great, thank you so much. I think safe to say that everybody's found that very interesting. I think that we might have to wrap up now. But thank you to everybody as well for sending in all of your questions.
Okay, my pleasure.
Thank you so much. You too. Thank you very much.
Yeah, thank you so much, Roseanne.
Sure.
And we look forward to having you again with the VC Society, maybe with another collaboration with QTech.
Sure.
And thanks everyone for tuning in.
Anytime. Thank you.